Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are solving Pelta company question. This is 295 question number from your Kaplan kit, and it's also a past paper question, as you can see, was asked in December 2017. So without any further ado, let's get started. The first thing that we do is read the requirements, and only then do we delve deeper into the case study. So going through the requirements first, the first requirement wants me to calculate the NPV. This is for 9 marks. Then to calculate the discounted payback period for 2 marks, and discussing the financial acceptability, basically evaluating these two thresholds which I find out, and then critically discussing the views of the directors on the investment appraisal. So there must be something about the views, what the directors are thinking. So I have to critically discuss about it. This is for 6 marks over here. So let's get started. The first part that I have over here is to work out my NPV. So let me create the format for that. So years will be put first, 0, 1, 2, 3, 4. And since tax is paid 1 year in arrears, so I have to take year 5 as well. So yeah, this is pretty much what we are supposed to start with. So the directors are considering a planned investment of $25 million and payable at the start of the first year of operation. So these are the sales volumes. This is the selling price. These are the fixed costs, variable costs, all provided to us. This information needs adjusting to take account of selling price inflation, variable cost inflation. The fixed costs, which are incremental and related to investment return, are in nominal terms. So this is, this is something which you do not have to inflate because this is already in the nominal terms. So, all right, we have absorbed the information that is provided to us so far. So, year 4 sales volume is expected to continue for the foreseeable future, and company pays corporation tax 30% 1 year in arrears. The company can claim tax allowable depreciation on a 25% reducing balance basis. So, all of the things which are about the views of directors will not be helping me for my first and second requirements. It is requirement C that it will be helping me with. So let's get started. The first item over here will be my sales revenue, and for that I first need my sales units, and then multiplying that with the selling price, I will have my revenue figures. So first of all, let me put my sales units. This is 520,000. Second year it's 624,000. Next year it's 717,000, and in the last year it's 788,000. So these are the sales units which I have. Now let me take the selling price per unit. Now, how do I work that out? I have the selling prices given to me equals 30. It remains 30 in all of the years. So 30 multiplied by the selling price inflation of 4%. So 1.04, and raising it to the power of the year, I will have my individual selling price for all of the years. I can drag it to the remainder of the cells also. Now with this, I can find out my sales revenue. So my sales revenue is going to be the product of my sales price per unit and my sales units. So this is what my revenue figures are going to look like for this entire project. Now the next thing which I have to take over here is going to be my variable costs. So my variable costs are also given in per unit terms. My variable cost is changing every year, and I also have to account for the inflation. So it's 10 in the first year multiplied by the inflation of 1.03, raising it to the power of the year. Now for the rest of the years, since the amount is varying, you have two options. Either you manually put in the same formula, or you just copy paste it and then you change these amounts over here. So I'm going to go for this method where I change the amounts so that I save myself some time over here. I find this quicker. So 10.61 is what is given over here, and 10.93 is what I will take over here. Now these are my variable costs per unit. Now I can find out my total variable cost. Total variable cost is nothing but the cost per unit multiplied by the number of units I am selling. So this over here is my total variable cost. I can copy paste the formula to the remainder of the cells also. Now the next thing that I'm supposed to do, so the difference between the revenue and your variable cost is going to give you your contribution. So your contribution is nothing but sales revenue minus your total variable costs. So with this, you arrive at your contribution for all of the years that we have this project. Now, the next thing over here to take into consideration is our fixed cost. Fixed cost is 700,000 in the first year. Second year, it's 735. Mind you, I am not inflating this because it is mentioned over here that the fixed costs, which are incremental and related to the investment project, are in nominal terms. So if it's already nominal, that means inflation has already been applied to it. So I do not need to account for inflation, otherwise it will be double entry. So now after I have subtracted my fixed costs, I'll have my cash flows before tax. Now this will be the difference between my contribution and my fixed cost. So this over here can be dragged to the other cells, and now you have your cash flows before tax. Now your corporation tax is at the rate of 30% over here, and it is paid a year in arrears, which means the money that I earn in year 1, the tax I will pay in the next year, the year after year 1 is year 2. So I will pay the tax over here into 30%. So this over here is my corporation tax for the first year, second year, third year, and fourth year. So these are the taxes that I pay in all of these years. Now the next thing that I need to work out is my tax allowable depreciation benefit. So one thing which I can do is to, mention it that this is my working note, and this is my working note with regards to the tax allowable depreciation. So the first thing which I have is my initial investment, which I have at 25 million. So 25 million. Then the next thing that I do over here is first year's depreciation. So year 1 dep will be nothing but this multiplied by 25% because that's the rate of depreciation, and the benefit that I will be getting will be equal to 30% of this amount over here. So this is my tax allowable depreciation for the very first year. Similarly, now I can work out my written down value over which I will charge depreciation for the second year. So it will be the difference between these two. Now on this figure, I want to calculate the depreciation as well as the benefit. So I can copy paste this over here, and I can simply say that this is year 2 depreciation. The formula has automatically put up the first value and taken 25%, and benefit is at the 30% of my depreciation. So now I have my tax allowable benefit for the second year also. Now similarly, I can find out the WDV. So the WDV comes out to be this, and for the year 3 depreciation, I can copy paste the same formula over here. So year 3, and these are my benefits. Now in year 4, let's look if we have any scrap value given to us. So 25 million, no, I do not see any scrap value which is provided to us over here. The views of the directors are that must be evaluated over 4 years of operations with an assumed terminal value at the end of the fourth year of 5% of the initial investment cost. Okay, so this is the initial we have to take the terminal value, which is the scrap value, at 5% of the initial investment. So I need to work out the WDV for the fourth year. So on fourth year, this is my books, what my books are showing that the machine is worth. Now, if I take the scrap value is nothing but 5% of my initial investment, which is this right over here. Now I have my scrap value as well. Now I need to calculate, the difference between these two over which I will get any benefit or charge that is taken from me. So this is the written down value, and this is the scrap value. This is the difference that I get, and the benefit will be at the rate of 30% of this figure over here. So I have my tax benefits for all of these years. So TAD benefit. Now, when you're paying your taxes 1 year later, benefits also you will be getting 1 year later. So in the second year, I'll put the benefit for year 1. In the third year, I'll put the benefit for year 2. And so on, I will carry out this calculation. I'm doing nothing but linking these cells so that whenever the examiner is checking my answer, he will know where I got this figure from, and eventually he can come to this cell and see how I have done my working. So I'm making the work of my examiner easy, which gives me a higher probability of getting good marks. So these are my after-tax flows, after-tax cash flows. So these will be nothing but the difference between these. So it will be this value, cash flows before tax, minus any tax that you are paying plus any benefit that you are getting. So the same can be copy pasted to the remainder of the cells also. So these are your after tax cash flows that you will have. Now the next thing that we are supposed to take is our initial investment as well as our scrap value. There is no mention of working capital over here, so we can skip that. So the next thing that I take is my initial investment. This will be a negative figure shown in the year 0 because it is payable right now and it is an outflow which is going out of my pocket. That's why a negative sign over here. And then I take my scrap value. My scrap value over here, which I will be getting in the 4th year. I have just worked that out over here. I can link this cell to my calculation. So I have the initial investment as well as the scrap value. Now I can take my net cash flows and put the NPV formula. So my net cash flows over here will be the sum beginning from here to here. After tax cash flows, initial investment and my scrap value. So this is going to be what are my net cash flows over which I will be applying the NPV formula. So now let's get to the NPV formula equals to NPV. What's my discount rate that I'm supposed to use? The real after-tax cost of capital is this much and the nominal after-tax cost of capital is 12%. So I take 12% over here, select my flows from year 1 to 5 and then I manually add or subtract year 0. So this is what my NPV is going to look like and I can change the format to the currency format. Now this is the answer which I am getting over here. This is 104,74479. So this is roughly what your NPV is going to look like. Now the next thing which we are supposed to do over here is to work out the discounted payback period of the planned investment project. So the second part is about discounted payback period. So payback period is basically when we get our money back. So let us work out the present values of our flows and then we'll see after how much time are we getting our money back. So first of all, let me copy paste the after tax flows. So these are my after tax flows for the 5 years. Let me paste just the values over here. So 1, 2, 3, 4, 5. These are for the 5 years. And then these are my these are my net cash flows. So net cash flows. Let us also work out the present value of these flows. So the present value will be nothing but either you can go to the annuity tables and take out the factors. Otherwise, you can simply use the formula this divided by 1.12 because 12% is the cost of my capital and raise it to the power of 1. So with this, I arrive at my present value of the cash flows. Similar can be dragged and you will get the present values of all of your cash flows. Then the next thing that you do over here will be to find out the cumulative because with cumulative, you will know how much more is left to recover. So in the first year, your cumulative is this is what you are getting. In the second year, you're getting this, or you're getting this plus this figure. So in total, you have to recover 25 million equals to this figure over here. This is what you have to recover. So far you have recovered this much. So if you see the difference over here is this minus this, which means you are left with this much more money to recover. Now, similarly, I have recovered this much. In the third year, I recover this much more. So now I am left with how much more to recover? This minus this. So this is something which means if it has come in negative, which means I have already recovered my investment. Now, this was the amount that I was supposed to recover in the second year, and this is the total that I'm getting in the year. So how much how much time did it take for me to recover the entire thing would be this divided by the total that I'm getting in the third year. So this gives you 0.74, which means two years you were taking fully, because over here you were still left with a positive figure, which means there was more money to recover. Now, in the third year, you're getting a negative figure, which means you have recovered more than what you have spent. So to find out how much more time was needed, that is why we divided how much more was needed divided by the total, how much we were getting in this year. So this is what we got. So our payback period will be 2.74. This is what our discounted payback is in years, right? So the next thing that we do over here will be to answer part B, where we have to discuss the financial acceptability of the investment project. Now, if we talk about the NPV, firstly talking about the decision rule that NPV gives, NPV just has to be positive and you can accept the project. So we will write over here that the project is financially acceptable under NPV rule because it has a positive NPV. Now, the next thing that we worked out was our discounted payback period. Now, the discounted payback period, if we talk about what is the discounted payback period, that is maximum. In our firm, Pelta company, maximum discounted payback period is of 2 years. So this is exceeding 2 because this is 2.74. It is greater than your maximum target of 2 years. So if we talk about from the perspective of discounted payback period, we will not be going ahead with this project and we will reject it. So usually you will say that the NPV method gives you the best advice, and according to that, if that is saying to accept, then you should accept the project. This is how you will frame your answer for part B. Now, if we talk about part C, which wants us to critically discuss the views of the the directors on the investment appraisal. Let us see what their views basically are. All investment projects must be evaluated over 4 years of operations and the assumed terminal value. Okay, both NPV and discounted must be used, and they've given us both the rates of capital. So their views can be divided into 3 perspectives. First of all, they're talking about the evaluation period of 4 years. So in the case study, it is mentioned over here that the year 4 sales volume is expected to continue for the foreseeable future, which means that sales will continue beyond year 4, and directors are ignoring that. So investment appraisal will not make a lot of sense because we are ignoring all of the sales that we are getting after year 4. Maybe if we account for everything, we can get a changed figure, and that can lead to a changed decision also. Then the next thing which they are talking about is the terminal value that they are assuming over here. Assume terminal value of 5% of the initial cost. Now, there is no reason or there's no factual analysis which they have presented to us that why it should be only 5%, why not 10%, why not 15%? Because, we are not getting any reason behind that, why they are doing it. So maybe we get a higher scrap value, maybe we get a lower one. So this will probably, impact what the decision is, because this is a flow that we are taking in the last year. A greater discount rate is applicable to it. I mean, the present value that comes in the fourth year is very less compared to the previous years. So it is not good that they are taking this value without any specific reason that they have given us. Then the next thing which they are talking about is both NPV and discounted payback must be used. So talking about the discounted payback, directors should, tell that why anything which is more than 2 years, they are rejecting that. Because, there may be a possibility that they may be thinking that if the payback is in 2 years, the project is less risky. But the fact that it is not it is not taking into consideration any cash flows that happen after the payback, that is a big disadvantage of our discounted payback method. So we should mention over here that the directors should ideally be basing their decision on the NPV method rather than the discounted payback method, and hence they should be accepting the project. So these are the three reasons, three paragraphs that you will make over here, which will give you your 6 marks. With this, we have come to an end to this question. Do let me know in the comments down below if you have any queries or if you want me to solve any other question. I'll be happy to do that. I hope that this was useful. Thank you so much for watching.